We've got a number of questions. In fact, quite a thick wodge of questions here. Fortunately, some of them overlap with each other, so I'll try and get through as many as I can. The first question is that following Macondo, Oil and Gas UK are currently consulting with the industry on bringing into place new financial responsibility guidelines. And I guess the question is, are these seen by the smaller companies as being of a particular issue or onus? Maybe, Paul, as you were on the working group, you could maybe...
We've been working on these guidelines for a number of months now, and obviously there are companies of very differing sizes as far as their balance sheets are concerned. For the smaller companies, when you look at what's available regarding financial responsibility when you come into, or giving certainty to government that when you come into drilling wells, you have that available to you, really the only option that companies of our size have is through our insurance policies, which actually makes things a lot simpler, not necessarily cheaper, but a lot simpler as far as government is concerned. When it comes to larger companies that are going to utilise their balance sheet, it will be understanding how government assess their balance sheet, and I don't think the government have really got their act together or understand how they're going to be doing that.
Anybody else want to add anything to that?
We'll be in the same position. I mean, we've reviewed the guidelines. We haven't been as actively involved as Paul has, but I think it is insurance for us. It'll be exactly the same. And I think the response we've seen post-Macondo is absolutely appropriate. But at the end of the day, accepting that things have to change, not challenging that at all. But on the other hand, again, if you're out with looking in, it's just one more thing, one more barrier, if you will, that has to be addressed or crossed. So as we see these things stacking up, I think we always have to keep that in mind. Appropriate response, yes, but let's just make sure we keep the balance going forward.
Right. Thanks very much. For those operators out there that haven't got back in terms of comments on the consultation, we're looking for it by the end of this week. So hopefully we'll get some. They're starting to come in the comments. Hopefully we're in the right place. Right, now to move on to some other pieces. I think firstly, access to capital is probably a key theme through all the three talks. So maybe start with Tom and work along. So the question here is access to debt or equity capital. Which of these do you see as the most difficult, potentially critical?
I think they both have their own challenges, and those challenges are different. Debt, the debt market, I mean, this is a bank or a group of banks who are looking to lend money to your business. And the one response we've seen over the last 12 to 18 months as we've been talking with banks is that they want to lend against a portfolio of assets of minimum size with a diversity of sources of production so that that's de-risked. So if you have a more focused production with one or two wells below a certain threshold, really they're saying, come back next year when you broaden that a little more. So I think the challenge coming from a proportion of the debt markets that traditionally operate in our industry are moving companies like ours up the scale and basically suggesting that there's a minimum level of viability if you want to take money from us. And now we have a bank syndicate that's made up of Royal Bank of Scotland and NIBC, and they've been very supportive since we first took debt from RBS in 2008, and that syndicate has grown with the business, and we would expect it to grow going forward. But in the grand scheme of things, I think there's a wider group that want to see some minimum level of diversity, minimum level of scale. So that's the challenge that we've seen in the debt market. On the equity market, I think it's just the potential for pandemonium is the big risk and big uncertainty there. We've been in the equity market twice, once in 2010, once in 2011, and we started to feel like someone in Greece is watching for when we put out our announcement so they can start making mischief. We raised equity through issuing stock back in January. We did it on an overnight book build, which is quite common in the Norwegian market. And we capped out at the maximum amount of money we wanted to take into the business. And I'm pretty sure we could have issued more stock and raised more capital at that time. So I think it does come down to your story, the use to which you're putting the money, and how that's received in the market. It's very much a case-by-case basis.
Thanks. Paul?
As far as equity is concerned, as I mentioned earlier, it's quite a fickle market. Quite easy to raise money if you're in East Africa at the moment, but not necessarily in the North Sea. And you obviously want to raise money when your share price reflects what you believe to be the true value. And for many companies in the North Sea, that isn't the case. So you wouldn't really be looking to raise equity at this current time if you could help it. But for some companies, of course, they have no choice. It is still open, the equity market. At points in the past, it has been shut where there's been no possibility of raising any equity. So it is a matter of picking your time and going for what you need, and probably a little bit more at the time that's appropriate for you. Like Tom mentioned, debt is very difficult unless you have a portfolio. Unless you have existing production, it's very difficult to access it as a small company. From our point of view, we decided that it wasn't the route that we were going to go to. We needed to go to a source that would provide the money that was required for a development, and a source that understood the risks that were being taken. So that's why we approached the oil industry. And the oil industry provided what we needed through our farm out.
Fairfield is solely based in the UK, so you mentioned it was difficult in terms of the North Sea, so we're obviously operating in that environment. We use debt. We contemplate debt for project financing, for example. But I think and we clearly had a go at the markets a couple of years ago, and as far as we're concerned, that was the wrong time, and today is probably still the wrong time to even contemplate a run at the market. It's part of our thinking going forward, but we have to be very thoughtful about when you would actually go back to the market. I think the thing that we're thinking about the banks versus the likes of our investors. One thing that I'm very confident about is that the investors that we are dealing with, whether they be existing investors or indeed new investors, and there's a lot of dialogue on the go. There are people out there with checkbooks, which is good, but they do take, despite what my perception of the private equity people is, of course they need to get the money out, but actually they do take a long-term view, and I think that's an easier conversation to have when you're talking of cycles of 8, 10, 12 years. We were just discussing this at dinner last night. 8, 10, 12 years before you can sort of get to the success story that was described this morning. That's a conversation I think you can have with a private equity investor. It's a much, much more difficult conversation to have with a bank.
Great. Thank you. There's two here, and maybe we could just cover these very quickly. One, I think, is about equity funding, and one's about debt funding. So letters of credit are an inefficient use of capital. Are there alternatives on offer? And then the other one is, for funding, is there any real alternative to sovereign wealth fund? Which is Tom?
Yeah, I'm just thinking. Okay, letters of credit. I think it depends on the purpose you're putting the letter of credit to. It's used as a substitute for cash, but it really is cash, certainly for a company like us. And in a contracting situation, a rig or vessel owner may wish to see an LC in place so that they know the money is there to fulfill the contract and to pay for the contract. Escrow mechanisms do the same thing, but they do it explicitly. They lock up cash. I guess where I was talking about alternatives was where, particularly in an asset transaction, an LC is reached for to provide a backstop guarantee for a number of things, not just abandonment liability, and for meeting obligations under an SPA or performance under some other contract. And it's a very, very inefficient use of our capital. Other forms of guarantee, or perhaps a mixture of carrot and stick, may be appropriate in these circumstances. I think it's a little bit of imagination rather than just reaching for the sledgehammer in the drawer, because at some point that elastic band will break, and you suddenly find you don't have a counterparty on the other side of the table. The second question was?
Sovereign Wealth Fund.
Sovereign Wealth Fund. We've raised quite a bit of money into Bridge and Silverstone and the two different things, and none of that came from sovereign wealth funds. So I think there are other sources of capital.
Thank you. Paul?
We've not tapped into the market like Tom with sovereign wealth funds. As far as I'm aware, all of our money has come from normal institutions when it comes to equity. I would concur with your view, Tom, that LCs are a very inefficient use of funds and a very expensive way of guaranteeing contracts. If someone was prepared to take it, obviously parent company guarantees is probably a better way to go. But again, as a small company, they aren't necessarily looked upon particularly favourably.
So full house, inefficient use of capital. And we are absolutely constrained because we've got tens of millions of dollars literally locked up, unable to invest. So nothing substantive to add to the comments from my colleagues. But I would like to add one thing, and that's actually something that I've observed in our business, is that when you get into these LLCs and the different arrangements, the different tiers of funding and so on and so forth, it actually makes it very difficult to run the business. And if you're actually trying to talk to somebody about what it is you're trying to do with the business, and then you layer in the complexities of all these different securitization arrangements, you actually end up in a place where you almost convince yourself to do what is clearly the wrong thing from a business perspective. And you've got to be absolutely anchored in what is the right thing to do from the business, especially if you're talking to people who are actually delivering the business. And then you have to manage the complexities that these additional requirements, securitizations, LFCs, or whatever, bring to the table. So I'm not sure what is available as an alternative, but I tell you what, we could really do with something that's a lot simpler and more transparent in order to run our business.
That's a heartfelt plea to all the bankers in the audience. Okay, let's move off finance onto technology. Clearly, innovative technology adoption is a key to the smaller companies. So the first question here is, early adoption of technology. Are there enough of us willing to try out new technologies in the North Sea, or are we continually striving to be second to try it out? I guess the question implied in that is how do we break through to getting early adoption of new technologies?
I'll take that. I think we were talking about it during the break. It really does depend on the type of technology you're talking about. Is it something that is critical to the production from a well, or is it something that, if it doesn't go right, is not necessarily going to put your business at particular risk? And really, when we come to that, I mean, the areas that we've concentrated on adopting new technology has been on seismic, and there have been some wonderful developments as far as new seismic is concerned. Please don't ask me any technical questions. But we have built a reputation as a company that is prepared to adopt new technology, and we act as a test bed for these new technologies. But if they go wrong or if they don't work, it's not critical to the project. And you have to have that ability to do that. Putting in a new pump, for example, into a production well is something that's unlikely that we would want to do, because if it doesn't work, it's a major problem for us. But certainly when it comes to seismic, we will look at what's available. And if you build a reputation as a company that is prepared to accept and try new technology, then you'll find people knocking on your door, because all of these companies need a test bed, and they need to be able to show to the bigger companies, probably the bigger accounts as far as they're concerned, that this technology works, and we're a very good location for that.
Before I move on to the others, there's one specifically here for you, Paul, and as you've said, don't ask you the technology questions. I'll just maybe put you in touch with the person who's put their name on the top here, but it says what innovations specifically will be required to produce heavy oil, which I'm sure you can put somebody in contact with them. Unless you want to.
I can answer some of that. To be quite honest, as far as heavy oil is concerned, we are very lucky in the North Sea, and we have some exceptional reservoirs, and we can produce relatively viscous heavy oil at significant rates in the North Sea, and that's really the benefit of the reservoir. So what's required above and beyond standard production techniques, to be quite honest, in our case, not a great deal. If you're getting to very, very viscous oils, then you have some issues that need to be addressed, such as trying to find some way of either diluting the oil in the reservoir, or finding ways of adding some heat to the reservoir, which will add to the production. But really, standard things that we need to deal with, I mean, the biggest issue that we had to deal with on our production test, and fortunately we got it right, was sand control. And that's because we've got a very good reservoir.
Ian?
Again, similar theme, seismic. We're shooting seismic over Dymond. We expect that is going to really help inform our decision-making process for our exploration potential to the west and the south of Dymond. But, you know, those that are willing, I actually am unsure that we have choice. The pictures I showed of stairs being lowered onto Dymond, you know, if we had done that conventionally, you can imagine the tonnage of scaffolding. You can imagine the risk we would have taken actually putting people out on the underslung scaffolding, et cetera, et cetera. So in this environment, I'm not sure that it's a case of willing. It's, you know, you have to be able to do that. So when I think about our developments, Clipper South, multi-fracking, Crawford, potentially multilaterals, multi-phase pumping, production topsides. You know, how do you handle? We've got the aging installation issues, but lots of technology challenges there in terms of replacing carbon steel with something else, some other type of piping. But the one area that I think is really staring us in the face is that thing we all hate to talk about, which is, again, decommissioning. What are we going to do to really innovate in the decommissioning world? Because as somebody, you know, you talk about funding. Funding is good, running out of money is bad. When we enter into that phase of decommissioning, there is no ready supply of cash. We've got to do it for the amount of money that's made available to us. And we really have, I think, a challenge staring us there in the face. And if ever there was an area, a sector, but it's very unappealing, obviously, as a sector. But I think unless we tackle that, with the risks that's associated, and risk typically means the potential for lots of money, you know, that is a huge challenge to us. I think the innovation, you know, that's an area that innovation needs to look to.
Tom?
I think all I'd add is, I mentioned in the presentation, Victoria was developed with a fracture-stimulated well, which I think at the time was seen as being something new. But I mean, from our perspective, we had significant elements of our management with a lot of experience in Western Canada, where there are hundreds, if not thousands, of fracture-stimulated well. This was seen as an everyday thing. So there is an element of the application of technology in a new context. It is context-specific and where your perspective comes from. But I'd also echo Paul's comments that, you know, we do have to manage quite a bit of uncertainty between the market, financial, oil price, and subsurface uncertainties. Taking on incremental technology risk is something that drives that rush to be second.
Thanks very much. There are a few more technology questions here, but I think to some extent they're about how do the independents get together and how can contractors and governments and others help move the technologies forward, and I think to some extent we've answered those questions. So I think in view of time I'll move on to questions about exploration. And there's a question here about, you know, how do we stimulate or how does government stimulate E&A activity? If the promote worked in the past, you know, is that a spent force now, or is that still an innovation to go forward? So this is about questions and thoughts about promotion of exploration in the UKCS specifically.
I think we can take a particular perspective on this because we're active both in the UK and Norway, and many of the people in the room will be familiar with the fiscal terms in Norway, where the Norwegian government guarantees to refund you the tax equivalent portion of your capex spend on exploration, whether you're in production or not. So if you spend $100 on exploration, if only that could be true, $100 on exploration, you get $78 back. And you get $78 back a year in arrears, and the banks very helpfully lend you the money equivalent to approximately 78% of your spend for 1 year until you get the money back from the government. So it means that you can be quite an efficient explorer from an equity perspective in Norway, and you're not saving up losses for the future against your dry hole expense. You get 78%. So the Norwegian government is a 78% partner in every element of exploration activity you pursue, whether that's seismic or drilling or just license characterization. I have seen a number of proposals through industry bodies around why couldn't we do that in the UK. It's a good question. Certainly the experience in Norway after the introduction of the new fiscal term saw a very rapid increase in the number of companies, the number of wells drilled, and the number of successful wells and discoveries made, including some of the most recent largest finds in the North Sea for 20 years. I guess I would caution that and balance that against what it does drive is a lot of pressure on a finite group of resources, particularly drilling rigs. And I would say a large part of that 78% refund effectively goes to enhanced and increased rig prices and utility prices in Norway. So it's not quite a net-net. We can still drill good quality prospects in the UK that compete for our capital right now, despite the 78% in Norway. So it's not a panacea for all ills, but it is certainly a strong incentive that has seen a lot of activity put to good use in the Norwegian sector.
Yeah, as far as promote licenses are concerned, obviously we look upon them very fondly as it was our entry into the North Sea, and it proved to be a very successful first block to acquire. If we have criticisms of the promote blocks, it's the fact that you've got to get all the work done before you start looking at drilling a well within 2 years, which is a very short period of time. It may sound like a long period of time, but if you're looking for existing data, acquiring that data can take time, and if you're going to interpret it in an appropriate manner, if you've got short periods of time, I think we would argue that they should be longer periods. But it has been successful, and we do think that the 21st round did go a long way to rejuvenate the North Sea and introduced a lot of new companies. But as the licensing rounds have become more competitive, which they have over recent years, the tendency is for people not to look at the promote as an opportunity. They tend to go for traditional licenses, so very few promote licenses are actually applied for nowadays. And I think to a greater or lesser extent it's because the fact that you're limited to this initial 2-year period. If that could be amended, I think maybe there'll be more use.
So I think the only point I would add to this is it's associated with the time. It's the same theme as I think has emerged previously around resources. To the exploration round, 27th exploration round, more applications than we've seen in the recent past. So clearly that bit of the machinery is working, but how do we translate that into actual results? Is there the rig capacity? Is there the people capacity? Is there the seismic capacity? Are we really able to deliver against the resources? And it doesn't matter whether you're on the operator side, the service side in terms of resources. The challenge is just as strong on the regulator side. And the regulator has to be sufficiently resourced in order to be able to respond to the demands that the industry is placing on it. And I must admit, it's inevitable, isn't it, post-Macondo? We can understand the situation we're in. We're also in this austerity environment. But we have to be cognizant of the resource pressures on the whole supply chain, from the regulator all the way through to the drill rig, and actually getting that bit turning to deliver the results.
Okay, thank you. I think the move from exploration, I've got a few what I'd call curve balls here. So Ian, are you up for the first curve ball? Most of the staff of the independents were trained by the majors. What are you doing to develop your own people?
In an independent world, it's actually very hard. And we've asked ourselves repeatedly, can we as an independent take a young graduate in and actually mentor, coach, and support graduates all the way through? And now I'm going to go personal. I'm not sure that an independent can do that. Thus, we can't do the conventional training, if you will, for graduates. But that does not stop us having regular dialogue with the universities, whether they be the English universities, even the Welsh universities or Scottish universities, in terms of things that we can do and opportunities we can present, be the case studies or whatever. But I also think that the independent can do something that I found personally difficult in the majors. We can give people experience and exposure to things they've never thought they would do in their careers in the independent. We rely on the broad-based skills that, yes, I have to acknowledge, comes from the majors in a sense. That's where you typically get your training, and we can offer people those opportunities that you can't. So I think there's room in the world for both. I do also recognize that you have to think of that all the time. thus our ability to actually say, this is what we're doing in terms of discussions with universities, et cetera, et cetera.
Thank you. Paul, your curveball, there's three of them and we're running out of time, so your curveball is, why does heavy oil now trade at a premium to Brent?
There's a number of reasons. The amount of oil, heavy oil that's been produced in the North Sea has declined considerably over the last 10 years. I think at one point we were over 200,000 barrels a day of what would be described as heavy oil being produced. I think we're now down to about 50. In that period of time, there's a number of specialist refiners who have got very used to using this heavy oil and found that it's ideal for their requirements, and they do have specialist requirements. And finding less of it available has forced the price up. And some of the more conventional producers of heavy oil, such as Venezuela, we've seen a reduction in the production from those areas as well. So supply side is affecting it. And on the demand side, we're seeing a lot more demand for middle distillates, and heavy oil tends to meet that market. And also specialist products. If any of you drove to here today, you'll have driven on one of the products that is specific to heavy oil, and that's the bitumen on the road, or the asphalt on the road. And that is a very important element to heavy oil production, one of the products that comes from it. So there's been a tightening of supply mainly, and an increasing demand worldwide for the products that come from heavy oil.
Thanks, Paul. And Tom, I'm afraid yours is the most contentious curveball of all.
Great.
Are the independents better supply chain payers than the majors?
I think you should ask everyone in the room, right? Yeah, I would, precisely. Yeah, well, we have to be because you've got our letters of credit if we don't pay you. So yes is the short answer.
Great, thanks very much.
Actually,
right.
can I just add to that one? Because actually, I do think that, I don't think that's a curveball. I think that's an absolutely straight question, and I think it's something that as an independent we've absolutely got to be on our ball all the time. And I can safely say that, certainly in Fairfield, we monthly look at our invoice record. And we've got KPIs, and we're looking to make sure that we, assuming that there's no disputes, of course, you always have to put the disputes to one side. But it's absolutely something we look at every day, because if we don't do that, then I don't think we're actually credible in the marketplace.
Yeah. Thanks very much. Okay, and I think the last two questions, which we just have time for, sort of point to the next breakfast, so I'll read them out anyway. What steps should the government take to address the monopoly of infrastructure ownership? And should infrastructure ownership be moved out of the E&P companies into utilities, like in Norway? I don't know who wants to start us off on that one.
I mean, it's a big topic, and if everybody's willing to stay around for the next hour and a half, we can have a full discussion of it. But we, like many independents and many companies looking to drive developments forward, have had issues about infrastructure access. I mean, I think there is a laissez-faire approach by government and DEC to a certain extent that companies will sort themselves out. We've seen a couple of examples where the teeth, to the extent they exist in the current legislation and guidelines, have been invoked with some degree of success. But some degree of success still occurred at delay and additional cost, which I think the parties involved would have much happier to see avoided. So I think it's not perfect. I think a more active role and some ability to be directly involved and to force an outcome in a more direct manner, I think would be welcome for a lot of smaller companies.
Thanks, Tom. Quickly, Paul and Ian, if you can give a word or so to set us up for the next session.
Well, very quickly, by luck or by judgment, we've managed to avoid getting involved in projects which are dependent on infrastructure. The three major projects we're involved with are standalone, so we haven't had that frustration to deal with, and I do hear the frustrations from my colleagues, and I'm very glad that I'm not going down that particular avenue.
So, very, very rapidly, I'm going to draw a slightly strange parallel here. For years we have absolutely been talking the safety message, making sure that the safety message from the top is heard all the way down through the line. And I think now, it's only now that we're actually getting our supervisors offshore who actually understand that at the very top, if we talk about safety, we're serious, we mean it. I think we've got the same issue in the commercial arena. We have the senior management, the leadership, clearly intent on moving this industry forward. But actually, does it translate into behaviours that support that vision at that sort of the commercial manager or commercial supervisor level? So I think as well as having the right government support, the regulator, I think we have to look at ourselves pretty seriously and contemplate our own behaviours.
Great, thanks very much, Ian. That's a great note to end on. So I'd like to thank all our speakers, Tom Reynolds, Paul Jennings and Ian Sharp. Thank you.